And joining me on the podcast and on video, it's Vadim Alexandre, Head of Healthcare, SP Angel. You're right, Vadim.
Yeah, good. How are you, Justin?
Good, very arty in the background there. What is going on in the back screen there? If people checked out the video, it's like something in an art gallery somewhere.
This is a real wall. It's not just the back screen. Yeah, it's look like I can actually touch it. There you
Is
go.
it finished? Is that the design? Is it finished? Is that what it's like?
Yes, exactly.
It is very arty. It's nouveau industrial kind of thing. Okay, so it's half done.
Yeah, that could be.
It's like, have you finished yet? Yeah, that's it. What? When are you coming back to the rest?
Downturn, we had to.
Yeah, they cut him halfway through. Can't afford to pay you the rest of it.
Couldn't get enough paint.
Yeah. Thanks for getting the wallpaper off. We can't finish to get the painting done. Okay. So market's not looking too bad. Listen, I mean, I'll show you the screen. I'll show you I always like to show you the AIM all share because
I do feel they've bounced this week. I agree with you. I feel we've seen the FTSE 100 rally, but now the small caps are starting to move a little bit too.
Yes. So this is the AIM all share, and you can see if you draw the previous high was in January after the rally from the lows in October, and if we draw a line even from the highest close, we're now above that, which is a good sign, very good sign. And if you look at what's called relative strength index, it tends to get overcooked to over 70. In fact, stocks don't really move until they get over 70 or shares. But anything over 80, you think, oh, it's going to have a pullback. Very few share prices exist when it's at 80. It's it's overbought. But right now, look, we're not even at 70. So there's room to power ahead here. It's not overcooked, it's not overbought. So I'm quite liking that. It's very good.
Stocks are bouncing a little bit. Some of the small cap healthcare companies are starting to move up. It's good. Yeah, no, definitely.
Yeah. I want to talk about I know you've mentioned them before, Cambridge Cognition. I want you to give the bull case if you could, and I'll give the bear case because I put them through my MicroCap League filters, and I'll show you in a bit. But they came out with results this week.
Yeah, absolutely.
And let me just scroll up here. So let's get the top headline results up here. So this that's Argentech. Sorry, that's different coming. This obviously was 31st December, and they develop and market digital solutions. So that's brain health. But there we are. There's the figures. 7% up, 13.5 million. What's your thoughts?
You've got it. So look, I'm a long-standing holder of this stock. I've sold some in the past. Might sell some in the future. It's a stock that I think you kind of have to play right now. So if you look at the chart, they've had highs of like 180p. They're hovering around 50p right now. Okay. And have seen lows of 20p several years back. So the question now is this now the time to buy? And that I think that's are these results a buying signal? That I don't know. Okay. Are they historically undervalued? Yes. By their, just the chart there describes it. Is this a company that, and the reason I like it, do they have the revenues to back them? Are they in a cash crunch? No, they're not. Okay. So these results a little bit, so they put out a trading statement a couple of months ago. So the results aren't that big of a surprise. Everyone was kind of forewarned in the trading statement of what the results would look like. So, but what we can glean a few things from the results. One is, is there a concern that things are slowing down again? Because they effectively kind of profit warned, I think, last September. And there was some concern that the slowdown would continue. Turns out it didn't quite continue, but then again, it's still ambiguous. So I think the jury's still out. So what are we talking about slowdown? So basically, they're facing a whole bunch of biotech and pharma companies that are going through their own issues, right? So large cap pharma is cutting back on some of their work, and the smaller biotech companies are struggling for cash. So they're a lot of their programs aren't kicking off or are not they're not extending they're not buying new services from service providers like Cambridge Cognition. So you have this issue where the market itself is going through a bit of a the biotech market, because there's less biotech capital going around. Companies are not able to raise money, so therefore they're not able to complete their programs or start new programs, right? So that's
the trickle down effect is affecting them, or the lack of trickle down, basically.
Correct, exactly. So in the face of that, revenues aren't as fast as they used to be historically when the biotech market was really hot. Okay, but I think things could be much, much worse, and they're not. And that's the reason for that is because of the area they're in. You know, a lot of new dementia drugs are being investigated, or you know, because there's a couple that have come to market recently. It's you know, it's an area that is a very much up and coming area, and I don't think, you know, there's CNS, which is central nervous system, you know, all these brain health drugs. They're all, that's kind of a future area of growth for pharma companies, so that it isn't going away. So their broader market trend is healthy. It's just this current downturn in biotech, which is affecting them. Now look at the revenues that they've said they have. They have about 13.5 million in revenues. Okay.
Yeah. So this is this year, last year, the half year. In fact, they've H2 seem to be better than H1. So they did 6 million at H1 and 13.5 for H2. So they've obviously increased in H2.
Correct. So you look at that H1, and that's where the first kind of profit warning happened, right? So that hit their shares earlier in the year, well, late last year. Okay. Yeah. And then the question became, is that going to continue? So there was a concern. The trading statement, I think in January they put out, kind of calmed us all down and saying, okay, the slowdown has effectively stopped, but it hasn't quite. You know, I mean, they're still facing slower take on of contracts, et cetera, et cetera. So they've given us now a range of, in terms of expectation for 2024, saying it'll be, revenues will come in somewhere between 13 and 15. Okay. And I think that's fair, because, and that's the key, right? It's not the historic results are 13.5 million. That was already in the trading statement of January. It's all about the outlook for this coming year. So what they've said is Q1 is pretty strong. You know, they're happy with their result for Q1, and they're tracking to do at least as good as last year, so 13.5, let's say, or hit the full up to 15 and show some growth. Okay. So I think finding a halfway house and saying 14 for the full year is probably about accurate, right?
Yeah.
And I think, given that we're 4 months almost in, you know, we are 4 months into the year, going out and saying that, it gives us a good indication how things are going to go. Now, the one thing they did say, which, you know, always does bother me a little bit, is it's going to be back end weighted. But look at this year, it was back end weighted too. So we are seeing the market improve. The biotech market is improving. And that's what they're seeing reflected in their own conversations and their, you know, their order book. They have visibility on 9 million for this year from their existing order book, right? So they can do 9 million of the, you know, forecast. Let's call it, we're calling it 14. Let's call it 14, the midway between their 13 to 15. So they have 9 million of it covered, and the rest has to be made up in new business. So that, you know, that's the call on this company right now. You know, the valuation, I think the price is good right now. But in terms of entry points, you know, one has to make that call. Do they think that, you know, the second half will kind of pick up again?
Okay. So I'd say you're a cautious bull, maybe.
Yeah, I think, I guess that's the best way of putting it, you know?
Yeah.
One has to, you know, admit that, you know, there was a slowdown. They've admitted it. There's no, that's what's in the statement. And it's just trying to assess whether or not that slowdown is getting worse. I don't think so. That's the good thing. That's the good news. Will it, you know, pick up with a vengeance in the second half? They have a second half weighting last year. They'll probably have it this year. So I take their word for that, you know, it will be second half weighted. By how much is the decision one has to make. If it ends up being 15 plus, okay, in terms of revenues, then all of a sudden they've smashed it and they're back to strong growth. And, you know, the stock, if the stock moves, well, then you've missed the bottom. Okay. Yeah. But, you know, that's the caution. That's where you have to kind of make a judgment. One other thing is that they have the other positive, they've taken a substantial amount of cost out of the business. So they've said that they've taken another, I think, 2 million out of the on a run rate basis, 2 million on the full year of costs out of the business. So you can see, and that's why they're going to hit their expectation. Even though revenues are a bit softer, they're going to hit their profitability expectations for the full year. And they're moving into, you know, I imagine they'll be moving into cash generation then as a result. So that's good. So it's the self-sufficiency that's important. Plus they have 3 million on the balance sheet. They do have some debt that they've drawn down, but they have 3 million in debt, 3 million of cash in the balance sheet. And if they're going into cash neutral territory, then they're healthy, you know?
Yeah. Okay, well, it's a tale of the tape here. So they are a market cap of 17. Broker target there, 400% up. And I can't, I don't know, I don't know how they get into this. I mean, I often say I do put forecasts on my, I look at the broker numbers and I put multiples on those, on the sales, on the EBITDA, and on the profitability, net profit, and I try and work out where they are. And sometimes my targets and their targets are wide apart. And this one they are. Either I don't know how to value the company, or they're very overly bullish, or seeing something I'm not. But so enterprise value.
It's like a 4x sales, right? Roughly, or a bit more.
Yeah. So the key is, like you say, these are small companies. They need the growth, and so we got, like you said, 3.2 of cash, 2.5 of debt. They did operating cash flow 5 million, pretty much, minus 7.8 there, but they got cash there. Like I said, top line 7% growth. It's a bit flat. I mean, price of sales is fine. So you would value this? So you would value this on what? How many price of sales on what multiple?
Right now on a sales multiple, I would say probably about 2x is kind of like a good average for this company. So they're probably low on 1x sales, roughly.
Yeah.
They're a bit higher than 1x sales, but they've seen highs of about 4x, right? So they were I think they hit almost 200p last two years ago, right?
Okay.
And their sales were lower, right? So they have hit those kinds of numbers. Will they hit them in a 12-month time frame? I don't think so. I don't think that's fair, because do I believe it'll be a 4-bagger in 12 months? No. But do I think it's a multiple that should be more than 1x sales? Yes.
Yeah. Well, on the total scores here, I put, it's like, through many multiples. I mean, many metrics: so growth, value, health, efficiency, momentum, and potential. There's a top score of 100 there. They score 27 here. That's largely down to growth and value because, like I said, they are highest scoring metrics. But the health is okay. So amber is sort of okay. Green is good. And red is, have a look at it. So you've got quite a bit of red here, but efficiency, gross margins, good. Obviously, that'll drop through. Momentum is a problem, but it's going down to forecast. If you look at the forecast, they've got only 3.6% for 2024. Then it picks up then 25, 26. They're talking double digit, 14% pretty much across there. And so what have I put? I put on 1.3 sales there. And I'm getting not much upside, but they've obviously gone for more than that. Like I said, if they get the probability, which they're assuming they will be, this year, 500,000 EBITDA, 100,000 of pre-tax, of net profit, of pre-tax profit. So yeah, it's an improver. But what it's in the chart, like I said, it's sort of flatlining, and it sort of seems now, if they are improving, then it seems to be very good that they can flatline. What you want is a breakout up to the upside above these previous highs, because you can have flat lines, and then that's a bit of a flat line, but then you can break down. So you want it to break up pretty much above that line to get the momentum going, because that would denote then they've got some, like I said, and if you look at the 200-day moving average, last time this came down here back in 2019, there's no point trying to jump in. If you jumped in there on the flat line, but it gapped down, and even here on the flat line, it moved down again. So what you want to do is, like I said, nice break of that 200-day moving average, and then moving upwards, and that would give it extra points on my system anyway. And so right now, whereas 200-day, it's not quite there, so we have to go sideways for a while. It's odd when you look at these charts. I would say that would be close to the price. If they dump it on the bottom here, when they release the next trading update, maybe in a couple of months' time, it'll probably be there, and they probably break that quite nicely. And so if they break it above those previous highs, that'll be quite good. But like I say, I think the worst is priced in here, isn't it? I think,
I would think so. That's my point, is I feel it's, but okay, let me tell you what I'm thinking in terms of my position. So I'm thinking over the next 6 months, the next quarter, we'll find out, we'll get interims sometime, or some trading statement, as to how the first half's gone. Where I'd be a bit, maybe selling a bit of stock, in terms of either contracting my position, is if it's just radio silence in between. Do you know what I mean? If I get like kind of no news, and then no news, and then no news, and then wait for interims, I might start to get a bit edgy and take some off the table. Do I like it long term? Yeah, I do. So I think I'll keep some under any circumstance. But it's kind of how the news flow evolves over the next 6 months that will determine, do I maintain? Do I top up? or do I let some go? Do I let a bit go? And if it's radio silence, that it bothers me because historically they've announced bigger contracts. You know what I mean? And they've made those announcements. If you don't hear anything like that, I'm not 100% comfortable with that if that's what occurs. So yeah, I think that'll answer.
Yeah, well, they do say, don't they? A company rushes out good news, but they delay bad news. That's so. If they're doing well, you'd expect to get a timely trading update saying that.
Yeah.
But like you say, if they don't say anything, it's radio silence for a while. Because then let's be honest. If they announce it, if they land a contract that's decent, they've got announced it, haven't they? And they will announce it. So
if it's substantial, if it's big enough to be worthy, like it usually historically for them more recently, if it's in the millions, like 1 or 2 million, they'll make an announcement. So I'd like to see that to kind of reassure us that things are picking up again, right? If it's just radio silence, interims, finals, or trading statements only, that might worry. So that's the thing to look out for. But at its core, it's a good business, and yes, it's gone through the same volatility so many stocks have gone through. It had double-digit serious growth in the upturn, and let's hope that returns. And that's in the next cycle, I think this is going to be a winner.
Well, I've just put some price alerts on it, so I'll get alerted on my app and phone whenever it breaks that previous high, or it breaks the 200-day, or even starts an early alert is breaking the 50-day moving average, and then and that's the thing, this could be a good turnaround, very good recovery play, and recovery players can do very well. But what you mustn't do is jump in before the recovery happens, because that's the big risk. You've got to be convinced by the figures, nothing else, the figures only. Regardless of what's, because I've had CEOs and people talk about, oh yeah, they're doing well. The figures come out. No, you're not. Like,
I see. Yeah, I agree with you. And look, I'm not saying this. Just you're right about most companies. It's that, especially when that recovery is still ambiguous, and no one's saying it isn't really. You know what I mean here? We're all the macro environment in biotech is clear to all. It's for all to see. It's still difficult out there, and companies aren't splurging cash like they were in the past, right? When they were splurging cash, this company was growing 25% revenues, per annum. When they're not splurging cash, this is where this is testament to a good business. They're still growing 7%. Do you know what I mean? They're still managed. They're not, they're not getting destroyed by the downturn, and they're seeing their order book still maintained, and they're seeing interest, and they're seeing positives. So it's a good business. It's just that, they are still victims of the broader market. So I would want to see, if I were kind of piling into this or whatever, I would be looking for what we just discussed, right? Let's hear some news flow. Let's hear some, some positives over the next 6 months. And that gives us all more confidence that they've turned the corner.
Yeah, especially if they're cutting down on the costs. That's what you need, because like I said, they've got, 3.2 of cash. They did sort of use 5.1 decrease in cash last year. So
that, just so you know, they were still integrating their business with 2 other businesses. So that's, I would say that big cash burn is kind of behind them now. Because they're carrying the previous burden of the other 2 businesses, right? So part of that is a consolidation play, and they did take some of that cost out already. And now they've just announced that they've taken another 2 million out of that cost. So they should, if all goes to plan, if they hit their 13 to 15, let's call it 14, they should be a bit positive this year. So that's a big swing too, by the way. If you look at, like you just said, we just looked at the previous year's figures, and they're horrendous, right? On the bottom line, right? What do you have?
Exactly. But in fact, here, like I said, they're forecast to be into profit pretty much on the next year. So that would suggest, and the revenue hasn't got massively, so that would suggest the cash burn is going down quite a bit.
Correct. So you've got it right there. Exactly. Look at the EBITDA and look at the operating profit. minus 3 million going to washing its face this year and becoming profitable, right? On de minimis increase in revenue. So it was a consolidation play, those acquisitions. They've gone a bit further because the market's softer than they expected, and they've taken more costs and found deficiencies in the business. But I think that's playing out nicely, which means that if the top line starts to increase more than expected, the gearing will, the operational gearing will start to kick in on the lower cost base, more revenues, and all of a sudden you're more profitable than expected.
Yeah, exactly. I was just thinking there, what you can do, Vadim, on that wall behind you, just get a big black felted marker and put Vadim Alexandre. And that would be almost a nice backdrop to the screen here. It looks like it's part of a virtual thing. No, I've written that on the wall. Just say, tell your colleagues, no, it's for the Zoom call, so people know who I am. I haven't
It would work because it looks fake, right? It looks fake.
It does look fake. Yeah, it does. Yeah, it does. Marvelous stuff, Vadim. Thanks for that, and we'll speak to you next week.
Excellent. Thanks, Justin.